The housing market is changing again, but not the way that anybody expected. Everybody spent the last 2 years waiting for one of two things to happen: rates to crash or prices to crash. Neither of those have happened. And instead, we got this weird in-between market where inventory is rising, sellers are maybe negotiating, but buyers are still getting punched in the face with affordability issues. I think the biggest shift happening right now is something that nobody's talking about. That is, the casual home buyer is disappearing. The people who are still actively buying homes in 2026 are increasingly higher qualified, higher income, higher credit score, higher down payment, and they're just more serious. Today, we're going to break down the stats behind all of this, what's happening in inventory, why, depending on your market, you may be able to negotiate, or you might have to be super, super strong when it comes to offering on a house. This is that mortgage show. Let's get into it. Before we can even talk about rates or inventory, we need to talk about who is actually buying homes right now, because the demographic is shifting. Age of the median first-time home buyer is around 38 to 40 years old. A decade ago, it was closer to 30. So the old model of graduate college, get married, start a family, buy a house at 27 is gone. The version of America is fading fast. Today's buyer is older, they're more stable, they're more established, usually dual income, and much more financially qualified. The income numbers are pretty eye-opening too. The median first-time home buyer household income is now around $94,000, according to Realtor.com and NAR data. And in a lot of markets, honestly, higher priced markets, that household figure is actually six figures, because mathematically it has to be. Now, if you add in credit score, typical mortgage borrowers today are averaging around 735 FICO. It's a very strong borrower credit score. These are not reckless buyers making emotional decisions. These are highly documented, highly qualified, financially battle-tested buyers. And the down payments are bigger too. First-time home buyers are putting down 10% on average. Repeat buyers are close to 25% on average. What does this tell you? It tells you the active buyer today is older, wealthier, more patient, and way more serious. I think it's the biggest misunderstanding of the housing market right now. People think demand disappeared. It didn't. The casual home buyer got squeezed out by this market. And honestly, a lot of people trying to start their lives are getting squeezed out by price and by older, wealthier people who have accumulated wealth, really just as a factor of time, are coming in and they're offering cash, or they're offering higher down payments, or they're incentivizing sellers to go with them. It's really tough to watch. The last 4 or 5 years have been very hard for the housing market, and the people left standing are just simply extremely strong home buyers when it comes to credit, down payment, income, the whole ball of wax. And sellers are finally blinking as well in some markets. We'll get back to that in a second. But in most markets, inventory is quietly building again. Active listings are climbing, new listings are rising, and price reductions are spreading. Nationally, nearly 1 out of 5 sellers are now cutting price. That's a massive shift from COVID. Remember the old market? No inspection, no contingency, waive appraisal, offer $50,000 over asking and still not get it. Now that's happening in a few markets: Maryland, Pennsylvania, some parts of the Carolinas. So be careful. But nationally, we're in a really good and balanced market. We're seeing seller concessions return, rate buydowns return, repair negotiations return. And honestly, this doesn't look like a crash. It looks like a normalization. A lot of the nation's housing markets are normalizing. Now, to a lot of people, this is a problem. It seems like chaos. It seems like a crash. But to the more seasoned folks, the people who've been buying houses for the last 20 years, or lived in a house, or been in the mortgage business for longer than 3 years, they realize that this suddenly feels like a more normal market. Now, again, if you're in Pennsylvania, Maryland, some of the Northeast, pockets of different states, you could be telling a completely different story, and I understand that. But nationally and here in Florida, things are normalizing. So we're going to get a little local here to Florida, because Florida is becoming a negotiation market. Florida is one of the most fascinating examples of the shift. Florida exploded during the pandemic. There was a migration boom. There was an investor frenzy. There was a remote work gold rush. Who doesn't want to live on the beach and work? But now inventory is climbing. Days on market is stretching. Insurance costs, they're getting a lot better, but it worries a lot of people. Condos are under pressure. Fannie Mae and Freddie Mac just changed some condo guidelines. Affordability is getting smoked by rates. Doesn't mean that Florida is collapsing, but it means that there's leverage for buyers. Buyers who stayed patient suddenly have negotiation powers. Now, this can change in different pockets and different price points. If you're over the 1.2 million, from my perspective, it's still very competitive. But if you are toward the average 400, 500 price point and below, there is some rooms for negotiation. So as we go through and navigate all of these changes, I want people to understand that it isn't necessarily a crashing market because there's more inventory coming on. Rates have stabilized, and honestly, you got to keep your eye on the bond market, Iran, and oil prices. It's the last piece that consumers really need to understand. Mortgage rates are not controlled by the Fed. The 10-year Treasury note, I've said it a million times on the show before. Treasury yields, inflation expectations, government debt, economic data, global conflict, these all flow into the 10-year Treasury yield and mortgage rates, which is why the Fed can pause or lower interest rates, their federal fund rates, and mortgage rates can go up or move because it is dependent on the data, dependent on the 10-year Treasury bond. Until affordability improves meaningfully, housing probably stays in this strange spot. Not booming, not crashing, just grinding away slowly. And if for no other reason, we need rates to go down so the young people in this country who are buying homes to go live in, spend 20 years in, and raise a family in, have a chance. Because honestly, from my perspective, with my real world clients who are out there offering on 2, 3 homes in different parts of the country, and they're getting outbid by cash buyers who are selling their homes, pocketing a lot of money, and then going buying these 4-bedroom houses, these $800,000 houses, and bidding them up to $1 million, buying them in cash, and squeezing out people who are trying to raise families. I think more people need to understand that's going on. I think more people on all sides of the fence need to understand that piece. The housing market isn't frozen because people stopped wanting homes. It's frozen because monthly payments exploded. It's frozen because buyers are standing still, and it's frozen because they're just not as serious as they should be. Unfortunately, you got to face reality. If you want a house, you have to be super serious. Thanks for watching. I hope you enjoyed it. Please join me next time.